Buy now, pay later feels like the smartest way to shop. No upfront fees, no credit card, no bank involved. Just split the payment, move on, and deal with it later. But here's what millions using these services right now don't realize. Later has already arrived, and it is sitting on your credit file. Think about the last time you used a buy now, pay later service. Maybe it was for something small, a pair of shoes, a household item, something you needed before payday. It felt frictionless, a few taps here and there, no forms, no waiting, approved in seconds. That is exactly what makes this conversation important. Because when something feels this simple and this free, it's easy to assume it has no footprint, that it has no record, no consequences. And that assumption is quietly affecting people at the moments that matter most. And people who have been using BNPL casually for years are sitting in front of lenders or even mortgage brokers, wondering why their home loan application is being scrutinized more carefully than they had expected. People who have never missed a payment in their life are discovering that their BNPL history is now visible to lenders in ways which they had never anticipated. And this is not about fear. It's just about understanding what is actually happening behind the scenes when you tap that button today. And if you are new here, welcome. My name is Nova. I have spent over 15 years inside the banking industry as a credit risk professional. On this channel, I cover personal debt and lending through a risk lens, the side of the system most borrowers never really see but are always affected by. Everything I share here is purely for financial education and is not meant for personal financial advice. My goal is just to help you understand how the system works so you can navigate it with confidence. Now, there is something specific I want to come back to later in this video, so stay on course. Something about what lenders are actually doing with your BNPL data when you apply for a home loan or a personal loan. It is more detailed than most people expect. But first of all, let's understand what buy now, pay later actually is, because the regulatory landscape changed significantly and most people have not yet caught up with what that means for them. Buy now, pay later services allow consumers to purchase something immediately and pay for it in installments, typically fortnightly, over a short period of time. The appeal is obvious: no upfront payment, no interest if you pay on time, but fees including late payment fees apply. And historically, no hard credit check in the traditional sense. And for years, BNPL operated in a different regulatory space to credit cards and personal loans. They were not classified as credit products. That meant they were not subject to the same responsible lending obligation that applied to banks and other credit providers. That has changed recently in Australia, and BNPL providers are now required to hold a credit license. They're now subject to responsible lending obligations and they must conduct credit assessments. And the regulatory oversight that applies to other credit products now applies to them as well. And honestly, this is not a small administrative change. This is a fundamental shift in how these products are classified and regulated. It means the frictionless, consequence-free experience that BNPL was built on is legally and structurally different now. And if you have been using these products under the assumption that the old rules still apply, you are operating with outdated information. And I just want to pause here because the phrase responsible lending obligations get used a lot, but some of us using these products may not know what it means. Responsible lending obligations require a credit provider to take reasonable steps to verify that the credit product is not unsuitable for the consumer. In simple terms, they need to check that you can actually afford what you are taking on without it causing substantial hardship to you. And for BNPL specifically, this now means providers must conduct some form of credit assessments before approving an account or a transaction above a certain threshold. And the depth of that assessment may vary depending on the provider and the transaction size, but the obligation to assess is now there. What this means for you as a user is that applying for multiple BNPL accounts in quick succession, particularly for larger amounts, may now trigger more formal credit checks than you used to, and those checks leave inquiries on your credit file. There is also a practical implication in the other direction. If a BNPL provider has conducted an assessment and approved your account, that approval is on record. And if you later default, there is a documented trail. The era of BNPL sitting outside the formal credit system is over. Understanding this is not a reason to panic, it's just a reason to be intentional on how we use some of these products. So what does BNPL do to your credit file? Let me just walk you through the 3 ways buy now, pay later can leave a mark on your credit file. Not to alarm you, but because understanding each one puts you in a better position. The first is credit inquiries. When you apply for a BNPL account, even for a small purchase, many providers conduct a credit inquiry. This inquiry is recorded on your credit file by the credit reporting body. It shows the date, the type of credit applied for, and the name of the provider. And one inquiry is not a problem, but here is what matters. Multiple inquiries in a short period can signal to other lenders that you are seeking credit frequently. And from a risk assessment perspective, a cluster of inquiries can raise questions about financial stability, even if every single BNPL account was approved and managed well. The second is account information. Under comprehensive credit reporting bodies can capture information about open credit accounts. And that includes limits, balances, and repayment history. As BNPL providers integrate more fully into the credit reporting system under the new regulatory framework, account level information becomes more visible to lenders assessing your overall credit position. And multiple open BNPL accounts, even if all are being managed, represent credit commitments. Lenders factor in existing commitments when assessing your capacity to service a new loan. And the third I want to talk about is defaults, and this is the most serious one. If you miss on a BNPL account and the debt remains unresolved, the provider can list a default on your credit file. A default listing requires certain conditions to be met definitely. A default stays on your credit file for 5 years. It does not matter what the original purchase was, whether it was just $300 of clothing or even a gaming controller. The listing is the same as any other default, and it carries the same weight when a lender reviews your file. And I want to share with you a story that captures exactly how this plays out in practice. A couple saving for a home for, say, 3 years, responsible, consistent savers, no credit card debt, one car loan, managed well. They are genuinely in a strong position. When they sit down with a mortgage broker, they are confident. And most of the assessment goes smoothly. But when the broker pulls their bank statements, which is standard practice for any home loan assessment, something comes up. Across the two of them, they have 6 active BNPL accounts between them. None of them are in arrears, but they have a combined BNPL commitment of around, say, $400 a fortnight going out of their accounts. From a serviceability perspective, those commitments reduce their assessed borrowing capacity. Not so much, but enough that the loan amount they qualify for is lower than they had planned for. More importantly, the broker notes that the inquiry history from multiple BNPL applications has created a pattern that requires an explanation. And they get their loan, but they get less than what they had been working toward. And the BNPL accounts they had never thought twice about were part of the reason why they got a low amount. And here's the part I mentioned earlier that I would come back to. What lenders are actually doing when they see BNPL activity on your file or even in your statements. There are 2 separate things happening, and they are both important. The first is the credit file review. As we have discussed, inquiries, open accounts, and any default listings are visible to lenders who pull your credit report. Under comprehensive credit reporting, the picture lenders see is more detailed than it used to be. This is not new. It applies to all credit products, but people have historically assumed that BNPL sat outside this framework. It doesn't anymore. And the second is the bank statement analysis. This one is perhaps even more significant for home loan applicants specifically. When a lender assesses a home loan, they typically review maybe 3 to 6 months of bank statements. They're looking at your income, your regular expenses, and your spending patterns. BNPL repayments show up as regular outgoing transactions. Lenders categorize these as existing financial commitments. They reduce the amount of disposable income available to service any new loan. And if BNPL usage is frequent or represent a significant share of monthly outgoings, it can raise questions about spending patterns that the lender may want to explore further. Here is a reframe that matters. BNPL is not being treated harshly by lenders. It is being treated consistently the same way any other financial commitment is treated. The issue is not that lenders are unsympathetic to BNPL users. The issue is that many BNPL users have never thought of their accounts as financial commitments in the first place. And for me, that mental shift from it's just a payment plan to it's a credit commitment is exactly what this video is designed to create. So what can you do with this information which I am sharing? So whether you currently use BNPL products or are planning to apply for credit in the next 12 months, here is a practical framework. And the first step is that just get your credit file before your lender does. You are periodically entitled to a free copy of your credit report from the credit reporting bodies. Check what inquiries are listed, what accounts are visible, and whether anything looks incorrect. Reviewing your own file is not recorded as an inquiry and does not affect your credit position. Do this before you apply for any significant credit products. And the second step is just consolidate your BNPL accounts before applying for major credit. If you have multiple active BNPL accounts, consider closing the ones you are not actively using before applying for, say, a home loan, a car loan, or a personal loan. Open credit limits, even unused ones, represent potential liability from a lender's perspective. Fewer open accounts means a cleaner picture. And the third step is that understand how BNPL repayments appear in your bank statements. Look at your last 3 months of statements and identify every BNPL repayment. Add them up. If that number is significant relative to your income, it's worth understanding its impact on your borrowing capacity before you apply. Different lenders factor these commitments into your serviceability assessments differently. And the fourth step, if you have a BNPL default listing, address it proactively. A paid or resolved debt is read differently to an open one. If you have an outstanding BNPL debt that has been referred for collection or listed as a default, getting that resolved and documented as resolved puts you in a materially better position. The listing may remain on your file for the 5-year period, but the status change matters to lenders. And the fifth step, if you are unsure where you stand, talk to your lender or broker or financial counselor before applying. A broker can pull your credit file, review your statements, and give you a clear picture of how your BNPL usage is likely to be assessed before you formally apply for credit. And this prevents the unnecessary hard inquiry that comes with an unsuccessful application. And as I close, I just want to reiterate that buy now, pay later is a legitimate regulated financial product. Used consciously, it is a useful tool. Used carelessly, it leaves a trail on your credit file, in your bank statements, and in your assessed borrowing capacity. The system is not punishing BNPL users. It's simply treating these products the way it treats every other form of credit. The gap is between what users expect and what the system actually sees. If this gave you a clearer picture of what is happening behind the scenes, share it with someone who uses BNPL and has never thought about the credit implications. And subscribe, because next week we are going to something else which I think is also quite interesting. And that one is also worth watching before you ever apply for anything again. Thanks for watching.